This bank didn't fail because of a recession. It didn't fail because of crypto, and it definitely didn't fail because of unpredictable market forces. Silicon Valley Bank collapsed because a room full of very smart people all made the same stupid assumption, and no one questioned it. And the scariest part? If you think this can't happen again, you're already part of the problem. And yes, it gets worse. On the surface, everything looked fine. Markets were open, startups were working, money was supposed to be safe. Then something subtle broke. A few founders noticed delays. A few investors started asking uncomfortable questions. And inside Silicon Valley, a quiet realization began spreading faster than any official warning ever could. Silicon Valley Bank wasn't just a bank, it was the bank. The financial backbone of startups, venture capital firms, and tech companies that quietly power your daily life. Payrolls, funding rounds, operating cash, all flowing through one place. And suddenly, that place looked fragile. Money started moving, then rushing, then fleeing. Not because people understood what was happening, but because no one wanted to be last. Even veteran investors were panicking, which is rare because they usually call panic a temporary liquidity issue and move on. By the end of the day, one thing was obvious. This wasn't a rumor. This wasn't noise. This was the start of a financial stampede. Regulators, headlines, and talking heads agreed on almost immediately. Silicon Valley Bank collapsed because interest rates rose too fast. That's it. Case closed, nothing to see here. According to the official story, SVB was simply a victim of the Federal Reserve's aggressive rate hikes. Rates went up, bond prices went down, SVB happened to be holding a massive pile of long-term government bonds, so on paper it took losses. When depositors got nervous and started pulling money out, the bank couldn't sell those assets fast enough without locking in billions in losses. Cue the bank run. Cue the collapse. Neat, clean, almost comforting, because this version makes it sound like a technical failure, a spreadsheet problem, an unfortunate side effect of fighting inflation. No greed, no misjudgment, no one really at fault, just math doing math things. But here's where that story starts to crack. Every bank in America faced the exact same interest rate environment. Every bank watched bond values fall. Every bank knew rates weren't staying near zero forever. And yet, only one of them unraveled in 48 hours. They'll call it bad luck, bad timing, a perfect storm. But perfect storms don't randomly appear. They form when risks are treated as irrelevant, when warning signs are dismissed as temporary noise, and when decision makers convince themselves that old rules no longer apply. This time is different. It's safe. We'll deal with it later. The official story stops at interest rates, because going any deeper means admitting the collapse wasn't inevitable. It was chosen, slowly, confidently, and in plain sight. Because here's the part they never mention. The interest rates didn't kill Silicon Valley Bank. They just exposed what was already broken. The real problem wasn't interest rates. It was the kind of bank Silicon Valley Bank chose to be. SVB wasn't built for normal people with salaries, savings accounts, and predictable habits. It was built for startups, venture capital firms, and tech companies parking millions, sometimes hundreds of millions, in a single account, often as temporary holding tanks between funding rounds. And almost all of that money? Uninsured. Which meant this bank didn't run on deposits. It ran on confidence. Because when normal people panic, they withdraw a few $100s. When tech CEOs panic, they move entire balance sheets in a single click, often at the exact same time after reading the exact same message in the exact same group chat. SVB took this flood of startup cash and did what looked responsible on paper. It locked huge portions of it into long-term US government bonds, assets that are considered safe only if one assumption holds. Interest rates stay low. No serious hedging, no meaningful protection, just complete faith that cheap money was a permanent feature of reality. The warning signs weren't subtle. Inflation was rising. The Fed was openly signaling rate hikes. Risk managers flagged concerns internally, but leadership kept repeating the same calming phrase. Relax, everyone else is doing it. This wasn't a freak accident. It was a slow, confident gamble, a ticking time bomb disguised as conservative banking. Like juggling knives and smiling and saying, "Don't worry, they're government approved." Up until this moment, everything was still theoretically fixable. Losses could be explained, liquidity could be raised, confidence could be restored. But then one thing disappeared, and banks cannot survive without it. Time. Once confidence cracked, the sequence was brutal and completely predictable. First came the withdrawals, then came the explanations, then came the denial. SVB announced it needed to raise capital. In banking language, that's basically shouting, "We're fine," while quietly sprinting toward the exit. Markets didn't interpret it as reassurance. They interpreted it as a warning flare. Investors didn't buy the story. Venture capital firms didn't wait for clarity. Group chats exploded. Slack channels flipped into emergency mode. Pull your money, now. What followed wasn't chaos. It was coordination. Startups initiated wire transfers measured in tens of millions, sometimes hundreds. Some hit daily transfer limits. Others watched frozen progress bars, refreshing screens as if staring harder might speed things up. Within hours, the pressure was obvious. Within a day, it was terminal. In less than 48 hours, more than $40 billion tried to leave the bank. That's not a bank run. That's a financial flash flood. SVB was forced to sell assets at massive losses. Each sale made the balance sheet weaker, which made the next wave of withdrawals faster. Confidence didn't just fade, it vanished. The irony was brutal. The same hyper-connected tech ecosystem that fueled SVB's rise also accelerated its collapse, instantly. Some experts later claimed this wasn't a real crisis, just a misunderstanding, a social media panic. But panic doesn't create weak balance sheets. This wasn't hysteria, it was a chain reaction. Greed, ignored warnings, denial, collapse. A slow mistake, punished at internet speed. By Friday morning, there was nothing left to explain. Phones were ringing nonstop, executives were out of answers, and somewhere between sunrise and opening bell, control quietly disappeared. Regulators stepped in. Silicon Valley Bank was shut down. Trading stopped. Accounts were frozen. For thousands of companies, payroll became a coin flip. For founders, years of work were suddenly trapped behind a login screen that no longer mattered. Markets didn't panic out loud. They went silent. Too silent. The second largest bank failure in US history happened almost politely, behind closed doors, while most people were still on their commute. If money could scream, this is when it would have lost its voice. And for a few hours, the entire tech economy held its breath. What most people remember is the shutdown. What they miss is what came after, because this collapse didn't end when the doors closed. That was just the visible part. For a brief moment, it looked like the damage had been contained. The government stepped in, depositors were backstopped, markets exhaled. Crisis over, at least on paper. But financial disasters don't really end, they just change shape. The collapse of Silicon Valley Bank quietly rewired the system. Banks reassessed risk models overnight. Liquidity suddenly mattered again. Balance sheets were examined with a level of paranoia that hadn't existed in years. Credit tightened, approvals slowed, risk tolerance evaporated. Startups that had never touched SVB felt the shock anyway. Fundraising became harder. Payroll planning turned fragile. Companies that were already living quarter to quarter found the margin for error disappear entirely. And then there's inflation, the invisible echo. The emergency guarantees sent a clear message. When things break badly enough, the system will intervene. That safety net doesn't vanish after the crisis fades from headlines. It gets priced in. And that price shows up everywhere. Higher costs, tighter money, and fewer second chances for those without scale or influence. People think the crisis ended that weekend. It didn't. Your cost of living today, your job security, your access to credit, all of it still carries fingerprints from those 48 hours, even if you never knew the bank's name before it failed. Silicon Valley Bank didn't fail because of bad math. The math worked exactly as designed. It failed because finance isn't numbers. It's human behavior, incentives, and overconfidence wearing a suit and calling itself risk management. Everyone involved made decisions that made sense locally. Chase yield, trust the system, assume stability would last just a little longer. Individually, none of it looked reckless. Collectively, it created something fragile, a system that worked perfectly right up until the moment it didn't. That's how modern financial crises happen, not with cartoon villains or secret conspiracies, but with smart, well-educated people agreeing too much for too long and mistaking consensus for safety. Money isn't the problem, people are. And every crisis teaches the same lesson, no matter the decade or the technology. Greed always wins the short game and quietly destroys the long one. And if this story felt fast, absurd, and uncomfortable, wait until you see what the next one looks like.
If you enjoyed this video, hit like and subscribe for more cool stuff they don't teach you at school.